just to recap, just where we were last week. I'm not going to show any slides, but just to maybe make sure that attendees who didn't join last week just understand where we are. Last week, we just did a brief overview of the climate finance landscape, talked a little bit about the key climate finance sources, did a deep dive into the African context and where there are still challenges for African countries in terms of climate finance mobilization, and then also some of the quantification of the current climate finance flows, but also what are the documented needs of different countries in terms of what they're disclosing within their biannual reports to the UNFCCC. So last week was, of course, maybe a bit away from machine learning and some of the data science methodologies that could be applied to various fields or various aspects of climate finance. But I hope that this week maybe brings us a bit closer to where we are heading to within the following presentations. I'll just maybe go to just what I'd like to talk about today. So I think when putting together this presentation, I was thinking about how to frame it in a way that allows for you to get an idea about the landscape of different instruments that are available, but also not to simplify it in a way that makes it seem that it is a straightforward process of selecting instruments given a set of circumstances or context. I think that's often the way that these presentations regarding climate finance instruments are presented. And personally, as a practitioner, I get quite frustrated with them because I think there's an oversimplification of the process. So what I wanted to do today was first talk about, also provide you with a landscape of the instruments and maybe go into depth with certain instruments and maybe stop at strategic points to ask you if you have any clarification about different instruments and how they work. But then also talk about how one would select those instruments in a given framework, given a set of circumstances or background context that need to be applied. And what I'll do a bit later on is talk about an example of where we see how these different instruments are used within a single framework and how, talking about a green bond in isolation often is maybe more of a theoretical example. And in practice, we often use these instruments together, trying to address different barriers in the same context, in the same financial context. And then I picked on a specific instrument and wanted to trace through the entire process of where we would see machine learning applications within the process. So just before I jump into some of the content, I will say, please, if you have any questions, feel free to put it in the chat. And I'll continuously try and answer them as we go along. I am always careful to say at the inception of a presentation like this, I don't have all the answers. I'm also growing in my field. All I can do is kind of draw on the experiences that I've had in practice and then also on research to try and communicate some of my own experiences within the presentation itself. So I'll just, sorry, I need to, last week I presented the slide within the presentation and I went over it quite briefly. And I just, it doesn't have any kind of specific typology that I've classified the instruments under. This is just, a very generic set of instruments that could be applied to climate finance. And I'm going to show you a better figure of how I've classified it. But maybe a starting point would be that often when we talk about climate finance instruments, there's different understanding of what that means. I think to a pure financier, you would be thinking about grants, loans, equity, bonds, guarantees. But I think within the climate finance space, a lot of the terminology is quite interchangeable. And you may hear things like climate finance instruments, climate finance mechanisms, even sometimes climate finance sources, approaches, modalities. And I don't have any clarification about how it should be. I think it's just something to point out that typically we're talking about the same thing. There isn't a uniform way of classifying the different instruments into pots. You will see in the slide that I present next that the World Economic Forum has a different way that they've classified adaptation finance instruments, and so too other commentators like the UNFCCC, etc., who have tried to put them into pots. But nonetheless, I don't think that's particularly important in terms of determining how we use them. It's just a very theoretical exercise that is sometimes done to try and understand how we can match instruments to a specific financial problem. As I've mentioned, I think one of the issues that arises is the want for recipes of how to apply different financial instruments in different contexts so that it's easier to be clear about what could be applied. For example, if you are raising capital, if you're seeking to raise capital for a particular project, you would jump towards some debt instrument, be it loans or green bonds or even traditional vanilla bonds. But are we thinking about the credit standing of the institution and whether some kind of risk guarantee is required? So it kind of leads me to the statement about the oversimplification of how different climate finance instruments are applied. And it's something that I just like everyone on the call to maybe just take note of, that when we think about financial problems, they're often more complex and they require more detailed investigation to understand how these different instruments can fit together. And I have an example that we'll go through in detail about kind of determining which instruments could be applied where and why. Often it starts off with some kind of assessment of the barriers. And I've put down a few classes of barriers. I've separated policy from political, technical challenges, financial and economic barriers, etc. Maybe just to kind of go through each one in a bit of detail, just to give you an idea about how this may change the selection of financial instruments. And some of this is based on real life case studies and practice. So if we think about public policy, there was a project that my team and I were undertaking in Kenya to try and look at how to stimulate bioethanol in the market, given that there was a real challenge with indoor air quality at the local community level. And one of the real issues was subsidies that were in place and VAT ratings for certain fossil fuel types like kerosene and paraffin. And within the project, we were lobbying the government to try and remove some of these barriers so that the price point for a private sector entity was better, so that bioethanol could become a more attractive option in the market, and that the private sector company would be willing to scale their operations and try and displace some of the kerosene and paraffin. So that's an example of maybe where public policy is the barrier to implementation. And of course, the focus needs to be removing those policies to try and stimulate climate finance investment that would ultimately result in climate finance flows. Political challenges are probably the most straightforward one. Just to maybe give you an example of what's currently happening, we see that changes in the US government at the moment are drastically affecting the way that ESG, which stands for environment, social governance, or climate-related financial disclosures, are being mainstreamed within financial institutions. So before the last US election, there was a huge movement by financial institutions to try and get an understanding of what their risk exposure is to climate internally. And that was really being pursued heavily by the regulators specifically, so the central banks. And since the current government, a lot of the want for financial institutions to start integrating some of these methods been has wavered slightly, and this has led to less focus on climate finance or climate related investments within private financial institutions, at least in some of the global north banks. So that's an example maybe of how political changes can change the way that climate finance flows. Technical, it's again related to one of the examples that I spoke about earlier with this Kenyan case study. So the bioethanol project was actually related to clean cook stoves, and one of the challenges within that project was actually that the clean cook stoves weren't fit to have bioethanol being used as the fuel source, and there was a need for those clean cook stoves to be constructed in India and then transported to Kenya and be fitted with the technology that basically makes the fuel source only applicable to bioethanol. Some other examples are satellite data sets within the African risk capacity, which is the major disaster risk pool in Africa, covering drought mostly. Data sets weren't available for the real-time monitoring of extreme heat and drought, and those needed to be procured from the World Food Programme, who now oversee the early warning system and the satellite detection of drought, which is linked to the financial instrument. And we'll talk about risk pools in a lot more detail later. Financial barriers, economic barriers are again quite, I think what we all think about when we think about barriers in general. So macroeconomic conditions being stable enough to explore green or climate finance options. A good example of this is pension funds and green segments. So if you have high macroeconomic stability, at many points, institutional investors feel that green markets may be more uncertain, and they need to firstly fulfill their mandate of realizing returns that are market related for people who have their pensions held with this particular fund, and it can kind of deter pension funds or more conservative financial institutions from taking going forward with asset classes that are maybe good in terms of long-term return, but there is extreme volatility maybe in the short term given some of the changes in the markets. There are a whole host of factors that I could point out. I just mentioned partnerships being needed in certain cases. Enabling conditions, I think we spoke about last week, about issues with human capacity, general awareness of the financial markets, etc. So just to give you an idea why I'm presenting this, I just wanted to go into, okay, that's probably the next slide, but maybe just to keep in mind that the reason why I'm presenting the barriers is that it formulates a context for why we apply the financial instruments that we apply. Later on, I'll present firstly the theory of the risk pool, and then go into some detail about why we choose the particular instruments that we choose. And I'd like you just to maybe remember the slide that I just presented, because it kind of touches on the barriers and how they need to be addressed. So what I've done in this slide is tried to create a typology of where I see the major financial instruments. This is by no means, this is very subjective, but I tried to put this across in a way that at least demonstrates, maybe the major need for using a particular climate finance instrument and what you would be using it for. There, as I mentioned, and that I can flip over to the next slide while I'm talking about this, but I'll go back to the previous one. There are numerous typologies. So just to maybe put some examples on the screen, if you look on the bottom right-hand corner, this is the BioFin, the Biodiversity Finance Initiative by the UNDP program. That is a hub of biodiversity finance instruments, but there are a whole host of different typologies. When we circulate the decks, I put these links in the slide note, so you'll be able to go back and maybe look at some of the different typologies and how they've been classified. But nonetheless, if we go back, I've tried to divide them into 4 parts. So, I would say that 85% of most of the climate finance, at least in the private market, is related to the first 2 categories. Under capital raising, we have it can be done in 2 ways, really. Either through debt or equity, and then some of the enabling requirements being fulfilled by grant type instruments. Of course, you can raise capital using very traditional financial vehicles. Vanilla bonds would work exactly the same as a green bond. It just depends on what you're trying to raise capital for. That maybe changes the label. You can get equity financing as a way of raising capital. Concessional debt relates more to the interest rate that you're able to acquire, maybe from a development financial institution, where sometimes the interest rate is slightly lower than market rates, or you maybe gain preferential payback periods, or you can start paying back the instrument after 2 years or after the construction phase, if it's financing something in the real economy, etc. So just to show you that there are variations in these types of instruments. The last 2, balance sheet financing, is what an institution would typically use if they have a good financial standing, and that's where they would raise capital from. The technical assistance and project work is, of course, very important in the African context, and it's typically been financed by grants. I've also put in some public sector instruments as well. So the conditional grants, for example, from the South African government, that's passed down to municipalities and provincial authorities. That would be an example of it. Maybe I wouldn't call it capital raising, but it is a way of increasing public budgets for a particular reason. So typically capital raising, maybe we think about as being external to what our balance sheet holds, but nonetheless still, it may still be valid in some way. Risk management maybe refers more to the combination of insurance and guarantees. There are many different types that I've listed on the slide. We'll talk a little bit about disaster risk insurance a bit later, because the risk pools would fall into that class. But indemnity insurance with coverage for particular natural catastrophes could also be classified as a climate finance instrument. Even political risk insurance that is used in a specific way could be classified as a climate finance instrument. I think maybe the salient point here is to just understand that it may be related to how these instruments are being applied, or what context they're being applied, that maybe make them applicable to be classified as climate finance. A good example that I always think about is if you are financing a traditional bulk water supply project, what makes that climate finance instead of traditional development finance? And there's no easy way of determining that, but it's typically being done by making the case for the climate rationale. So for example, if that bulk water supply was to try and increase water security in an area of acute drought, then that could be considered. And then we have more on the climate economic side, carbon pricing mechanisms. Of course, we have the carbon tax from the South African government, but you could also do things like emission trading, where you have a cap and trade system where entities have different caps of their emissions, and they can trade excess emissions that are available to other entities that are seeking to kind of offset their emission targets. You have carbon offset markets, which is the generation of carbon credits linked to some projects that have been implemented that have some kind of additionality component. And then you have things like traditional tax rebates, incentives. If you think about, for example, the solar incentives that were part of the South African government's budget, I think 2 years ago, maybe applied last year. That could be an example of a tax incentive. You also have land capture value, so maybe where service charges have linkages to environmental benefits. If you think about special tariff rating areas that are trying to raise capital for coastal infrastructure against storm surge, you could think about that as being an example of a climate finance instrument if there was a link to climate. Then there are some very unique, difficult to classify instruments, things like debt for nature swaps, pooled investment funds. I've even seen crowdfunding being used by a few cities to raise adaptation finance. And then, very traditional blended finance vehicles that come out of development financial institutions. Some of these could go into capital raising, but I think I wanted to make the distinction between debt and kind of these separate facilities as a whole. But I hope this gives you maybe an idea of the landscape, maybe not so much on how they're classified, but maybe just the range of options that we have available. I would I would hope that maybe you can go into the BioFin catalog, because I think there's about 64 or 65 different instruments that have been classified. And I think it gives you a good idea about how the different instruments could be used to address specific financial considerations. So I really hope that you check that out. I'm going to stop here strategically before I go any further and just check whether there are any questions before we deep dive into the risk pool component. Just anything of kind of clarification, maybe some burning question that you know now and that you want to answer on. You can feel free to just type it in the chat. You are typing. Maybe if you can just flag me so I can stop and just wait for you to have your question put up. It's also okay that you don't yet. We can take those a bit later on. I think what I wanted to do with the rest of the session was try and trace through a specific example, because I think it may help to make it more concrete about how the different instruments fit together, and then where the machine learning and data science components can be to enhance the structuring or development of these instruments. So this is some work that comes from my PhD. So this is the project was looking at flood risk pooling in the Western Cape and developing a facility that could basically provide protection to municipalities during times of flooding. And so what I'll do first is maybe just go through exactly what a risk pool is, and then provide you with a bit of context a bit later on about how different instruments fit together within the instrument itself, and then maybe just talk about briefly about why someone would, or why an entity would want to develop a risk pool. So um, risk pools are not restricted to climate. They have been used maybe more so in health, in health financing. It's also been used in public sector financing, where municipalities pool their risk together against very traditional types of risks. So things like just typical asset damage could be financed through something like a risk pool. But risk pools are really a way of creating quasi insurance facilities that almost function in exactly the same way as an insurance company would, where entities that pool their risk jointly are able to gain premium cost benefits because there's greater diversification in the pool. So just to give you an example, over here I have subnational authorities, but this could be countries. And if we move to the next slide, this is based on an actual example. We have the African risk pool, where we have African countries that have exposure to drought, pooling their risk together, so paying premiums into a pot, and gaining premium cost reductions because there is an assumption that drought will not happen in all countries in every year at the same time. So that's the kind of underlying thinking with why one would pool risk together. Typically, if you were a single country and you went to an insurer and took out an insurance policy, it would be more costly because you wouldn't have the diversification benefit of having the individual countries also pooling their risk towards the same peril. The African risk capacity is quite interesting because there's actually also this counter correlation of drought, where because it is across the northern and southern hemisphere, certain countries would also not experience countries in the northern and southern hemisphere would experience drought at different times. So that also enhances the ability of the risk pool to stay solvent over time. But just going back to a kind of generic structure for risk pool, you would have these entities, which may be countries or subnational authorities, or even individual companies that pay premiums into a risk pool facility, and they gain coverage if a specific peril arises. So if a drought occurs, if a flood occurs, etc. The risk pool itself, of course, funds within that risk pool do not stay stagnant. The management of the facility would firstly be required to take out reinsurance. So that would be insurance for the insurer. It could also access other capital market instruments that have the same function as reinsurance. So things like catastrophe bonds, catastrophe swaps, for example, that are used to address maybe higher risk layers, meaning that if you have certain disasters that have very high financial consequences, but maybe happen less frequently, you would finance that typically through a catastrophe bond rather than reinsurance. An example of this would be an earthquake. So an earthquake would typically, a pooling facility would rather pool the risk towards a cat bond rather than taking out traditional insurance. But that's obviously if they have only one line underwriting specifically for insurance, for earthquake risk, sorry. So besides the management of retained funds to insurance or capital markets, a risk pool also needs to consider how it integrates other risk managers. So it may require catastrophe modeling requirements. Often these models are based on satellite data or Earth observation data, which we'll talk about later. And therefore they require outsource services to almost manage that facility because, a risk pool would still be considered a quasi-financial institution. So it may not have those departments internally. You can also include things like like reinsurance brokers within this class. Um, Typically, because risk pools that are focused on catastrophes have a public service element, typically they also receive seed capital from donors. They also may receive subsidies from development financial institutions and national government. National government could also play a role as an insurer of last resort. So they're of the financial sector may play in kind of bringing a risk pool to fruition. So going to the example of the African risk capacity, as I mentioned, it was across different African countries. You can see, sorry about that, just moving chat window. The hazards covered is drought specifically, but they've subsequently started to expand to things like riverine floods, which they have a pilot on. The one thing that I'd like to point out with here that's of deep interest is the payout timeline. So you may be asking yourselves, why would you want to do a risk pool when you could just simply get insurance besides the premium cost reductions? One of the major benefits of these risk pools is that they're typically based on parametric insurance. So parametric insurance is where the structure of the policy is where you have an environmental variable that is attached to a loss model. An example of that would be, let's say we developed a heat insurance product. What it could look like is you use temperature above a certain threshold, so maybe above 35 degrees, and that heat spell lasting for X number of consecutive days. That could be your environmental threshold. And if that threshold is exceeded, there would be some financial loss that is based probably on historical data, but it could also be a model loss based on general economic data. And the one thing that's beneficial about this type of policy is that it allows for very fast payouts. So typically, the payouts occur 7 to 10 days after the disaster occurs. And that's really important because, and just to give you an example, the Durban flooding that happened in 2022, funds were only received by the municipality from national government about 12 to 14 months after the disaster hit. So during that time, the municipality had to use a lot of internal funds to try and manage the disaster, where a model like this, for example, would have the funds in your account very quickly and allow for some of that financial distress to be covered immediately. So just to point out kind of how it's different and maybe why it would be used, and maybe just to point out that one of the problems that has been cited by the African risk capacity is this issue of disaster aid being too slow. I think there's also a question on whether, countries should be dependent on disaster aid or whether they should be thinking about their own financial resilience. But this is exactly what a risk pool is envisioned to do. It's envisioned to provide financial resilience at times when there's a disaster. For anyone on the call who's maybe picked it up, the one thing that is difficult with risk pools is that it focuses on post-disaster effects. So even though it has that ability to create financial resilience straight after a disaster, the one thing that it doesn't do is finance proactive adaptation before. And it's one of the challenges of creating good incentives that you can kind of price into the model, but nonetheless, it's one of the challenges with disasters. So just going more into the theory before we go into the kind of machine learning applications, how you would typically use a risk pool is that you would not use it in isolation. You would typically use it with other risk transfer tools. When I say risk transfer tools, I'm talking about other insurance types where an entity doesn't hold risk. it transfers risk either to the insurance or reinsurance or capital markets. And how this would typically be done is on a cost basis. So, for example, if I could use the idea of flooding, if you were a municipality, you would not finance risk reduction or small-scale flooding through a risk pool. Typically, you would look at financing medium-scale events through a risk pool, and then very catastrophic, maybe 1 in 1,000 year events. Those kind of instruments you would be looking at very, you would be looking at things like catastrophe bonds and swaps for those types of instruments. Of course, with certain perils, you typically don't use layer 3. It's more for things like hurricanes, earthquakes, volcanic eruptions, etc. I think I've mentioned the other points, but within the African risk capacity, there's an equivalent Caribbean model and an equivalent Pacific model. All of the countries have experienced premium reduction benefits of between 35 and 50%. So there is a financial benefit of actually doing risk pooling beyond wanting to kind of make sure that you receive financial assistance quickly. It's also linked to the fact that you will gain benefit in terms of premiums being lower. And just to kind of go back, and this is the slide that I was talking about when I asked for everyone just to remember some of the factors that influence how we would use different financial instruments. So the slide. If we had to think about where the different instruments would fit into this maybe larger financial solution of a risk pool, you would think about, of course, the insurance policies that are being passed from the risk pool to the financial entities that are being covered. So, risk pool, insurance policies purchased by a municipality or a country. That's maybe the straightforward one. But often with risk pools, there's an issue of premium, being able to pay premiums. And it is a contentious issue because there's this want for the ownership of the risk pool to be dependent on the entities themselves, and it feels like they'll cultivate greater risk awareness, etc. But typically, there are some countries always within a risk pool that require some kind of premium support. So if you were thinking at a South African municipality level, you would think that local municipalities may require financial assistance to pay the premiums, whereas maybe the metros would be more buffered. If you think about it at an international scale within the Caribbean model, Haiti is of course, one of the poorest countries globally. So they required premium support, and they were able to receive grants from donors for that. So just an example of, you want to keep the risk pool size optimal because it increases the diversification benefit. So even though premium support packages may not be a way of cultivating that risk awareness, they are essential for making sure that the numbers are optimal within a risk pool. We spoke a little bit about grants for technical assistance and capacity building. So that's a very standard within risk pool development. But one thing maybe we didn't speak about is that initially a risk pool requires seed capital. And that's because in the initial years of its running, while reserves are being generated from premium costs, the risk pool could go insolvent. So for example, if we had to initialize a risk pool today and a large major event happens, a large drought event, for example, in the case of the Ark, happens across some of the southern African countries covered, it could make the risk pool insolvent immediately. So typically, donors would provide seed capital so that it's buffered at least for the first 10 years of the risk pool. We spoke a little bit about reinsurance. So an insurance facility would not keep funds stagnant. It needs to grow, or it needs to be transferred to the risk market. So Of course, there would be a certain portion of the retained reserves that go into financial investments to grow the pot. But of course, there is a certain a portion that would need to be moved to the reinsurance markets, catastrophe bond markets, and swap markets, so that it grows the pool and protects the pool in case disasters happen that maybe are beyond the financial capacity of the pool. And then lastly, this is something maybe more related to what we'll talk about in the next few slides about the machine learning components. You may have noticed that I've spoken a lot about drought and flooding and some of the environmental hazards. And typically, all three of the environmental the risk pools with kind of use cases linked to natural catastrophes require some kind of Earth observation, spatial data monitoring system. And this is done for two reasons. So first, you require that kind of understanding of historical trends, because there's a need to understand how you would create the policies and underwrite them according to historical exposures. But then also, insurance policies require real-time monitoring so that it can understand when a policy would be triggered or not. So we'll go into a bit of detail about how those mechanisms develop and maybe some of the machine learning applications. I'm going to, again, strategically stop here. So if there's any questions regarding risk pools, please feel free to write them in the chat. It's helpful because I can clarify them before we go on to how you would use machine learning within risk pool development. Does anybody have any chats or any questions or feedback? It's also okay that we can take that for the end when maybe you've seen the last 4 slides, and we can go forward from there. I'm not seeing any hands, so I'm guessing that. Oh, I see a hand. Clovis, I'm going to allow you to talk. Please let me know if this works. I think you may be able to unmute yourself and then say something. I don't know if you can test that. Sorry, Clovis, you're a bit soft, but we can hear you. Please soft for me.
Is it better now?
Yes, that's perfect.
No, I've added a few comments, which maybe you can reply later on, but specifically on the risk pool. And if we move to the AI environment, what we pick up, you'll see my comment there is the issue on data and data ownership and the flow of data within very specific regulatory frameworks. Maybe just your view on that.
Oh, so, my apologies, because I expected the chat to have a little red mark on it indicating that there was. I see that you did post your comments. So firstly, apologies, and I'll address that now. It's a huge issue, the data availability and data ownership, and we see that typically, with these large, I want to say, humanitarian disaster risk pools that are being created, there's a lot of momentum from the international community. So a lot of the data eventually gets within those risk pools, and you have, the World Food Program being involved, and other large-scale international donors that can provide some of the Earth observation data, some of the large satellite precipitation products that we need. So that is happening maybe at the kind of large-scale catastrophe pool level. I think your point also, I'm just looking at your comment linked to kind of index-based insurance that is maybe beyond catastrophe. So the traditional agri-index-based insurance that is maybe available to smallholder farmers, linked to things like temperature or rainfall changes. That data is very difficult to get a hold of in the kind of time series that is required. And it's the problem. It's a problem that we see in industry where it limits a lot of the development of these instruments beyond pilot. There are numerous pilots that have taken place on index-based insurance linked to agri, and it doesn't go further simply because A, the data is too costly to procure. B, sometimes data is proprietary and certain entities do not want to share that data, or they want to create agreements in place where they would still control the data, but the entity would maybe manage the instrument, but they would still have to pay a fee to the data provider, and that method is quite common. There is a huge push for open data with regards to catastrophe risk modeling, even beyond risk pools to the catastrophe swap environment as well. My view is that, of course, very strong proponent of having open source data that is available, and within research, at least there's an opportunity to do that. But I feel like unless the regulators start seeing that it's a delicate balance between commercial interest, because a lot of the data means that you can develop the product, and then that means that there's a commercial interest, but also the wider public sector benefit, which I think is the underlying issue. And I don't have a good answer for you about how we overcome that. I recognize the problem as well that
you actually confirmed for me. But I know from the World Bank there's a big drive on this open access.
Yes.
So one will have to monitor that, but that's for me a real issue.
Yeah, I think just within my own studies, I'm currently working on one in Malawi, and we've had to the example that I'm talking about is a real case where we had to actually create an agreement with the data providers so that they would house the infrastructure, and that we would tag into their platform, but we wouldn't be able to get the underlying data because that was seen as being commercially of interest to them. And I mean, it's
thank you.
Yeah, it's a
thank
big
you.
problem.
Thank you.
Hey, I think so. I just want to make sure. I'm just looking at time, which I cannot see. I'm just going to look at my phone. So we have 10 minutes. So I'm just going to go. I'm really sorry that it's overrun slightly, but hopefully next week we can. I'll definitely go back to this. So don't feel like you're missing out. But I just wanted to point out where machine learning could fit into risk pool development. So there are some use cases that are maybe straightforward. We know that a lot of the global climate model data is too coarse in resolution, so sometimes covering 90 by 90 kilometers, and that's often very difficult to make local scale predictions. Never mind using the data itself to actually, formulate, a loss model from. So there is this issue, and we have seen growing use of machine learning methods to try and increase the trust in some of the downscaling. Downscaling, when I use the term downscaling, I'm talking to trying to match the spatial resolution of a global climate model output with an observation on the ground to create some kind of relationship that would be reflective of the local scale measurement. Typically, it's better for temperature than it is for rainfall, but nonetheless, it is a necessary step if you're trying to make local scale conclusions. And we have seen machine learning being used more and more in industry, but also, of course, in research to try and make sure that we try and lessen some of the error. Of course, there's a huge issue with overfitting here because we are still talking about climate scenarios into the future, and there is wide variability in terms of what those scenarios could be. So sometimes the machine learning models tend to overfit, and sometimes the generalized case can be it can be difficult to balance that with trying to create a really accurate model. And as I said, it works better for temperature than it does for precipitation. Rainfall, traditionally, even with machine learning and reanalysis methods, they're still problematic in trying to get the error to being something acceptable. But nonetheless, it is helpful to maybe demonstrate that we are seeing these methods being used, firstly, within models. This is a study that was undertaken for temperature, and it was looking at a mountainous area, which I thought was interesting because we know that some of the global climate models do not capture high altitude terrain very well. So it was useful that the model, they used XGBoost and SVR, and they were able to try and get the models, down to a level of error that was acceptable to an insurer. So this is another good example of where machine learning has been applied. This example comes from the Caribbean Catastrophe Risk Insurance Facility. So this is the Caribbean insurance facility that I was mentioning. And this is an example of, where the way that payouts occur is linked to a decision tree that the insurance facility has developed. The underlying model is based on a very traditional kind of catastrophe risk model where there's an understanding of the hazard, there's vulnerability maps that have been created, and then an understanding of what that exposure means in terms of financial cost. We typically use these methods because we want to link the environmental trigger to the loss model. And you can use things like logistic regression, random forest decision trees. And maybe a better example that would maybe show this would be some of the flood parametric insurance work that's being done in Bangladesh, which is really scene setting, and some of the first products of its kind. And what they did was they linked flood inundation, so flood depth, to the loss model for Bangladeshi farmers. So, of course, Bangladesh is a place where they have acute flooding risk because of its some of the altitude and being below mean sea level. So this product was really a way of trying to protect farmers. They use supervised classifications, and you can see in the figure to your right that they used. It's been used in remote sensing, for a while, but they basically trained the data set using MODIS data, and they had it for quite a long time series, and trained it about where it would be able to detect water inundation linked to flooding, and then use real-time monitoring of those particular areas to then detect when a flood would occur. They don't use it for payout triggers specifically, but they use it for verification of payouts. So typically what would happen is that they would get a call from a farmer saying that, I have flood damage, and then they would use the system to then verify that that actually occurs. So I would say it's maybe a combination of a fraud detection system, and there are some elements that are linked to trigger development, but it's more probably related to fraud detection, or maybe reducing some of the basis risk. This is an example of where you would use it in terms of pricing or trying to integrate vulnerability within the pricing itself. So this is an example of hurricane damage that was undertaken, and the study was trying to evaluate what is the role of vulnerability. And typically within a lot of these insurance products that are being developed, a lot of the focus remains on hazard, so on the characteristics of the actual hazard that is occurring, and not really on the vulnerability of the policyholders to avoid or be less susceptible to the risk. And this study was undertaken because they wanted to evaluate how influential vulnerability was in terms of the damage or the financial cost of the damage. And if you look at, at the graph on your right, and the set of graphs on your right, the first set of graphs really relates to ranking the vulnerability indexes compared to some of the hazard characteristics. So things like average depth compared to the vulnerability index. You can see that vulnerability scores very highly. And the reason why you would want to do this in a risk pool setting is so that you can actually integrate vulnerability into the pricing. And it's quite helpful because then you start to get a distinction between policyholders that undertake risk reduction behavior and ones that don't. So you can actually create it as an incentive within the policy itself so that entities are able to maybe gain benefit in terms of pricing. It can, whether this happens or not in practice is maybe a bit more of an issue. Typically, the risk reduction benefits are difficult to price. So even though you can make a case for vulnerability, typically we don't really see it being in the prices as much as we would like to be. But it's just maybe an example of how you would use vulnerability mapping to integrate into an insurance use case. And this is the last slide. I focused a lot about kind of how you would do the loss development, how you would integrate parameters into pricing, how you would create the downscale data sets that maybe go into detecting the hazard. And then you would also potentially use a machine learning within some of the investment strategy, reinsurance allocation, and cat bond pricing. I put a few studies in the presentation of examples of where it was used in a way to try and address some of the optimization issues that arise in risk pool of kind of knowing when to allocate towards reinsurance or how to allocate to reinsurance in a way that reduces your probability of default, but then also allows you to have surplus so that you can invest and maximize your return of the risk pool. So it can be useful in those contexts, and we've seen reinforcement learning being used there. And then lastly, on cat bond pricing, I've seen a few cool studies that are trying to do this, but it remains very theoretical. Some of the more stochastic calculus methods are more useful and more mainstream rather for cat bond pricing. But just to give you a flavor that it is being, or entities are attempting to use them, but whether some of these methods are maybe mainstream is maybe questionable at the moment. I'll stop there. I know I've talked a lot, and I hope it's been useful. But I'll stop there and maybe hand over to anyone who wants to ask questions. You can please raise your hand, and I can unmute you. So you can, instead of typing in the chat, you can.
Yeah, Kamleshan, thank you very much. Sorry, I missed the beginning of your lecture because I had another commitment. But I think from what I heard, it was a very nice lecture. Thank you very much. And I can also extend the invitation to participants to ask questions. And if they raise their hand, we can give you the right to speak and upgrade you to panelist. Yeah. If not, just use the here. There is a question. Maybe you want to reply to that. Yeah.
In public sector, I can only relate this to climate finance, so machine learning approaches in public sector climate finance. The one use case that I have seen it being applied in is within the climate policy initiatives, climate finance tracking. So one of the real problems that we have is tracking private climate finance. And one of the innovative ways that I've seen it being used and applied to the South African Climate Finance Landscape Report is that basically CPI undertook an exercise where they looked at portfolios within different financial institutions, and they were able to classify based on text mining whether basically a certain project or a financial flow was allocated towards climate or not. And in that way, they were able to classify whether it was climate related, climate finance or not. And that was a really, that's the one that sticks out in my mind. I don't think it's mainstreamed as much as it could be or should be, or can be rather. But we are seeing some of these elements playing out. It definitely is being used a lot more in private sector. We see that a lot with with some of the insurers starting to develop in our approaches. So definitely more on the private side than the public side.
Yeah, thank you very much. Yeah, Kamleshan, if there are no more questions from the audience, thank you very much for another very nice lecture. And if you are happy to share the slides with us, we can upload them on the website next to the link to the YouTube recording of the school. That hopefully in a couple of days it will be in the YouTube channel. And otherwise, just a reminder to please join us again next Wednesday. Yeah, same time, same Zoom link. And maybe invite others to join, because I think today the numbers increased from the first lecture. So that's a very good sign, Kamleshan. Usually it's the other way around. So well done for that. Well done for that. Yep. Yeah. Excellent. Then thank you very much. We will see you latest next Wednesday, same time, same Zoom link. Excellent. Thank you very much to everyone. Thank you.